Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, it is time for the Investor Coaching Show, and I am Paul Winkler, talking money and investing, and I've got a lot in that particular arena to talk about today. We will get to a bunch of different things, questions, and a topic that came up this week that I thought I would walk through. And it's something that I don't talk an awful lot about, but I probably should talk a little bit more. We talk a lot about stocks and stock markets and those types of things. As we get older, we want to change and possibly have other investments in an investment portfolio. And we always, typically, even when you're younger, you'll have other types of things. But it always gets me when somebody says, hey, you know what? I want to have other types of investments in my portfolio, and they don't recognize that, when you're looking at the whole world of investing, there aren't that many different things really to choose from that would be investments. Like for example, when we talk about, let's say, commodities, we might say that we want commodities, but I look at it and say, well, it's not an investment because it doesn't have a cost of capital, right? So you look at that. But what are the basic choices that you have out there? What are the things that we can invest in? Well, you got stocks, of course, right? Now you can divide that up into a lot of different parts. You can look at large companies, small companies, medium-sized companies, value companies, growth companies, established international markets. You can look at emerging markets, those types of things. There's a lot of different things. And there are different approaches to the stock market that we've talked about here for years on the show. And one of them being, I'm going to try to figure out which stocks are better than others. A guy was asking me today, as a matter of fact. I didn't... I was been doing man on the street stuff where I get interview people talking, but he just made a comment and I thought, man, I wish I had a recorder going when he said this. But he says, what just gets me is when investment advisors tell you ought to invest in this company, you ought to invest in that company, and you go, well, why are you telling me this? Why are you telling me to get in or get out? Wouldn't it be just better to keep that information to yourself and you could make a whole lot more money? And I said, brilliant, you're exactly right. And I says, matter of fact, that is one of the lines I had in a workshop that I've taught for years. And, it was literally a line that I used about 30 years ago where I would just say, hey, if somebody really knew where things were going to go, why would they tell you? They would be way better off to keep that information themselves. So anytime somebody's telling you, I think this is what's going to happen, I think this is where things are going to go, just ask yourself that question. Why are you telling me? Because all that's going to happen is by you telling me where things are going to go, it may cause that thing to go up prematurely or go down prematurely. And maybe that's exactly what they want. If they own something and they tell you that it's going to go up, then your buying it will drive it even higher, which makes them right, number one, but it also benefits them economically because it goes up. So there are a lot of things that you just got to go, wait a minute, why are you telling me by this individual company? We used to get these faxes in the office here. And the faxes would be, you need to buy this company right now. It's a breakout company. It's getting ready to really take off. And it would be a thinly traded stock. And thinly traded stocks, because they're not traded that often, can be really, really impacted by any type of demand that is created for them. Any type of demand which causes people to say, I think I want to buy this, can cause that stock to go up because there aren't that many shares traded in a day, so you don't have that much supply, and therefore that's what ends up happening. Another thing that you might look at is, okay, so we have real estate. Real estate is an investment. It's also a job. When I buy real estate, I have to manage it. And I can buy it and hang on to it for long periods of time, but I got to manage. I can hire a manager, but then that takes away from the return. And then you also have the risks that come with it, just like anything else. Real estate has a cost of capital to it. In other words, you charge rent to somebody. and the amount that you actually make. I have people that show me real estate investments that they've got all the time, and typically I find it's in a range. I find some people are kind of like my dad. My dad. My mother was like, you got to own real estate. If you're going to be successful, you must own real estate. That was just that upbringing that she had. And I've talked about this before, but it's just funny. She would just go, my father owned real estate, and, everybody thought of him as a mogul, as a really, really intelligent, smart money guy. And unfortunately, there's a lot of mistakes that he made just because of bad advice that he was given. But my mother kind of picked up this idea that you've got to own real estate to be a successful person. Well, my father hated it because he hated the idea that you had to fix up this piece of property, you had to find a renter, and, if somebody moved out, you might have several months without rent coming in, and then, of course, they would do something to the drywall, they, smash a hole in the drywall, they bring their pets in there, and the pet would pee all over the floor, whatever. The air conditioner would break, there would be a leak in something. This happened a lot. They would have a leak in, let's say, a bathroom, and they wouldn't tell you for months. And then, of course, now not only do you have to fix the leak, but you also have to fix the flooring that has been totally destroyed as a result of that. Or maybe there's a window that there's a problem and water's coming in there. It's just roofing that was leaking. And then, of course, it destroys all kinds of other things. And the costs are way higher because they don't have a dog in the fight. There's no reason for them to go and report things right off the bat. Because, it's like, oh yeah, that's right, this was happening, I need to tell you about that. And then by the time they tell you, the problem is way worse. And so there's things like that, and he hated that. But the thing that he really didn't like is finding new renters. And for him, that was a pain in the neck. So what he would do is just say, okay, forget it. Here's what I'm going to do. I am going to just keep the rent really, really low. And therefore, nobody's ever going to want to move out. And that's exactly what happened. He had long-term renters, but his rate of return was terrible as a result of it. So that's one thing. Now, bonds, that is something that I don't talk an awful lot about at fixed income investments, and what the point of fixed income investments is and things like that. Now, some people will say, hey, you need to also have annuities. You also have to have other investments. I need to be able to have access to those things. And one of the things that I have said here forever on this show is that, we as a firm, and this has been my standpoint ever since opening the company over 25 years ago, we're just not going to do that. And the reason is because it creates what I see as being a conflict of interest. Now, you had that thing that I talked about, last week before, where in Texas, they basically had this thing that said, oh, you know what, we're no longer, and the Department of Labor didn't even show up for the hearing. We're not going to require that investment advisors have to do what's in the client's best interest. And the Department of Labor didn't even show up, which was very, very unfortunate. But, the insurance industry was giddy about it. They were super, super excited that they were going to be able to sell their stuff, and investment advisors could, quote unquote, investment advisors, I use that term loosely, were going to be able to recommend these annuities to people rolling over IRAs. And by the way, if you look at the Financial Industry Regulatory Authority, forever, it was really easy to find for years. Now it's harder to find. But they had a thing on their website telling people that using annuities in IRAs really was great for the investment advisor, but it wasn't necessarily so great for the investor. For years, that was just plain as sight on their website. And they would talk about the conflicts of interest. They would talk about increasing the expenses, that IRAs already were tax deferred. You didn't have to pay taxes on the gains year by year in an IRA. And annuities, of course, that's the idea. Non-qualified annuity, I put $100,000 in it, it grows to $150,000. I don't have to pay taxes as it grows to $150,000, but then it's taxed last in, first out, which kind of really stinks, that I have to pay taxes on the money on the back end. Well, the idea is that you paid a little bit of extra because the insurance company has their take on the amount of money that they're managing. They have a management fee. Then you have the funds inside there. If it's a variable annuity, you have mutual funds, you have a management fee there. You got the insurance company, and then you might have the investment advisor in there and the commissions, and that's going to add to those expenses, mortality and expense charges and things like that. So you have all these expenses. For what? Well, because on a non-qualified account, on a taxable account, you're actually not having to pay taxes on the gains. And you could justify it sort of kind of in a way in people's minds to pay extra expenses to not have to pay taxes on the gains year by year. So therefore, you could sort of justify it in your minds, even though I hated the tax consequences in annuities. You could make that point, right? That you could, that it made sense to pay a little bit more in order to get that tax treatment. Well, the point that FINRA was making, the Financial Industry Regulatory Authority was making, is that you already have that benefit in IRAs. Why would you pay extra for it? And that was super easy. That disclosure was super easy to find on their website forever. And miraculously, I can't find it anymore. Now, there are some law firms out there suing insurance companies that do have a copy of it on their website. Now, that's probably the only place I can find it these days, is the law firms that are doing the lawsuits. But, here's the point, is that there is this conflict created, and the annuities paying, you might have 5, 10, 15% commissions. I mean, just unreal commissions if you can get somebody to roll over their IRA from their 401k plan, and the deal just doesn't show up. They just don't show up for the hearing. So the insurance industry gets really giddy about this whole thing, and they're all excited that, hey, look, you can have, and the way they couch it is you can have the advisor of your choice. And I'm like, who would want an advisor like that? That would recommend that. So it has been our stance is, just going to stay away from them. There are no-load annuities out there. If an annuity is, let's say, the right choice for somebody, they exist. You don't have to pay commissions on them. And, people don't even realize that exists out there. Now, if we ever recommend them in our firm, we've always, in the past, we've recommended. We don't recommend them very often. But if we've ever had to use an annuity to maintain the tax status of somebody that had a non-qualified annuity. So let's say, in other words, you put $100,000 and grows to $150,000. You recognize the annuity you're using stinks, and you want to use something different. Well, if you move that out of the annuity, you got to pay the taxes on the $50,000. So you can do what's called a 1035 exchange. You can move it from one annuity product to another, in order to avoid taxation on that. And, if you did that, in our case, I would look at it and go, I'm only going to use a no-load annuity where there are no fees in, no fees out, so that you're not dealing with any kind of commissions or any kind of liquidity issues. Well, what happens is that, of course, the investment industry doesn't ever talk about those types of things. You rarely ever hear anybody talk about no-load annuities. Why? Because there's no commission in them. And why would I talk about that? So what happens is the investment advisor, I want to give you a full palette of everything. We want to be able to recommend we want to be your one-stop shop where you can buy everything. And we want to be able to sell you insurance products and annuities and all of that stuff. And to me, that's not good because it creates that conflict of interest. Now, a lot of people, I've heard people talk about, they'll say, well, Winkler doesn't like any of this stuff because he can't sell it. And I'm like going, wait a minute. I had an insurance license. I had a license to sell annuities. I had licenses to sell property and casualty insurance, auto and homeowners insurance. I've had licenses to sell health insurance. I've had licenses to sell stocks, bonds, securities, mutual funds. I dropped every last one of those. It was one of the hardest decisions I ever made in my life, to just drop them all because I didn't want that conflict of interest. So don't even go there. That's my point to any investment people that say, you can't, this reason you don't like this stuff, you can't sell it. No, it was one of the easiest tests I ever passed in my life, is going through the life insurance licensing. When I took it in New York, it was much more difficult. When I took the property and casualty licensing in New York, it was way the heck more difficult than it is around here. So don't even go. So I have had all of those. But here's basically what happens. Is I want to be able to add annuities to and my question is, well, wait a minute. What do insurance companies invest in? Let's say if you look at an insurance company like Athene a big seller of annuities. And I pulled this up and I did an AI overview. And what I did is I said, okay, so what is Athene investing in? They're a big annuity sales company. Well, they got about $292 billion invested in their asset portfolio, according to an AI overview, and they're pulling information. AI tells me where they're pulling information from, and it's their website. So it's the insurance company's website. So what do they got the money in? 35% in corporate and government bonds. What is it investing in? Bonds, asset-backed securities, structured product, commercial mortgage loans, a type of bond, mortgages, basically like a bond because you're paying interest when you have a mortgage, just like a company pays interest when they borrow money from you. Collateralized loan obligations, again, credit. Alternatives, they've got 5%, just 5% of their portfolio in equity securities and other investments. 4% cash equivalents, so it's kind of like a very, very, very short-term bond. Commercial mortgage-backed securities, again, mortgages. Residential mortgage-backed securities, again. So you go through that list, and only 5% of that money that's invested is in equity securities or other investments. The other stuff is all bonds, fixed income investments. And then they say key investment characteristics is what they say. High quality. Approximately 97% is available for sale, fixed maturity portfolio. That's what they're investing in. Okay, so that's one company. New York Life, another big seller of annuities. What are they investing? So you're buying their annuity. Why? To have an alternative investment to what I've named so far. So what did I name so far? I named stocks. I named real estate. I named bonds. And I said that commodities were not an investment. So you want to take that away from it. So there are only certain things that you can really invest in, right? So there are only limited certain things that are considered to be investments. I could say that I invest in art, but we look at that and it goes up and down based on supply and demand and luck. I could buy coins, but again, it's a commodity. It does, goes up and down based on supply and demand. It's not really an investment from an academic standpoint. So back to this, I'm saying, what am I investing in? When I buy this annuity, I am buying what? Mainly bonds. What's New York Life investing in? Bonds, that's their core holding, is what it says here. It says their investment portfolio is primarily backed by a conservative, high-quality, bond-focused strategy. So any investment advisor that's saying, I want to be able to offer you something else, an annuity, let's say, is really misleading you because you're investing in more bonds. Or you're investing in a commission-based product, which you can get in a non-commission-based form. So are they really helping you? I think they're helping you like Bonnie and Clyde helped banks. Pacific Life, how about them? What are they investing in? That was kind of scary. It's 39% private equity. Now you're dealing with things that you don't really have all that information on them, and you don't know what kind of level of risk. But again, mainly if you go down and you look at what their annuities are backed by, some of the stuff they're investing in, I was like shaking my head. But if you look at their annuity portfolio, they say in their disclosures, Pacific Life provides stable value, a principal protected investment option for retirement plans backed by a portfolio of bonds rather than stocks. So again, are you really getting a sales pitch that you're getting more diversification by investing in bonds? Or are you actually getting another area of the market or another investment? Are you diversifying more? No, you're not. The more you are armed about how the investing world works, you don't have to know everything. But the more you are armed, the less easy it is for an investment advisor to take advantage of you. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.